I'm delighted to introduce Jeff Franks, who's reminded me and told me he's actually from St. Antony's. He has actually an MSc in development economics from this very college, and also has a master's degree from Princeton and a PhD from Harvard in political economy and government.
Correct.
So it's really exactly in this line. Jeff has been more than 20 years at the IMF and has particularly interest in Korea in a lot of area diversity, having worked a lot in Latin America as well as Pakistan and a lot in Europe. There's also diversity in not only being in Washington, but having been resident representative in Ukraine and in Ecuador.
Yep.
And now, so he's done all the hard assignments, and they've now given him the hardest assignment, which is the Euro area. So very happy to welcome him. He's going to talk to us about Euro area. At the moment, he is the senior IMF representative in Europe, based in Paris as
in
well.
Brussels.
In Brussels.
Yeah. But I also in charge of the Paris
In
office.
charge of the Paris office. In my time, it was the other way around.
Correct.
But as Europe gets more integrated, it moves towards Brussels from Paris.
Yeah.
Yes.
Well, thank you very much. It's a lovely opportunity for me to be back here in Oxford. It brings back a lot of fond memories coming up Woodstock Road towards the college. What I'm going to discuss today is some research that I have just completed with some of the economists in the Paris and Brussels offices on convergence in the Eurozone. This was a topic that came up. We do these periodic brainstormings with our Euro area team in Washington about what the big topics are that we should focus our research on. And this was a topic, interestingly enough, when we first raised the idea about a year and a half ago, that our friends in Washington said, well, we don't think that's that important. So if you're interested, why don't you in Brussels and Paris go ahead. And by the time we finished the paper, it was quite the rage, and they took an extract of it and put it in the annual Euro area consultation last summer. So it does show that being in the field in Brussels on site can sometimes give us insights into what's really in the minds of European policymakers, and this is certainly one of those topics. So to set the stage for this paper, I would say that as many of you know, the economic recovery in the Eurozone has really begun to take root. It has broadened, it has deepened, it has strengthened. We're in a position now where in 2017, for the first time in nearly a decade, all 28 members of the EU were posting positive growth. And we have the sense in the IMF that this growth is not just broader, but also stronger and more likely to persist over time. We are now in a situation where I believe we've got something like 17 consecutive positive quarters of growth for the Eurozone as a whole. So things are looking much better in the short run. But there are some long-run challenges, and I'd like to focus, sort of situate the discussion of convergence in the confluence of this convergence challenge with a related challenge, which is a challenge of productivity. Because ultimately, if we're talking about convergence of incomes, we have to generate economic growth, and we need that growth to come from productivity. And I have I'll describe a little bit the different aspects of convergence that we looked at, then talk briefly about a few indicative slides on productivity, and then come back to the research on convergence. So when we talk about convergence in the press, I think everyone is thinking about income convergence, but that's really only one possible component of convergence of countries within the Eurozone. And for those of you who are familiar with the economic literature, that's not even the one that was most focused on when discussion of monetary union was originally advanced. We look in this paper at four related concepts of convergence. The first one is the real convergence concept. And that, of course, as I said, is what the newspapers mean when they talk about convergence. That is to say, our per capita incomes in poorer EU countries catching up to the income levels in the wealthier EU countries. But when the euro was beginning, I think these next two components of convergence were the ones that were most discussed: nominal convergence and cyclical convergence. By nominal convergence, we're essentially talking about, do some of the nominal indicators that central banks use to govern a common monetary policy, are they convergent with each other? And in particular, we're talking about interest rates and inflation. And as you're aware, there were specific criteria, the Maastricht criteria, which included criteria on both interest rates and inflation, saying that they had to be within a certain bound in order to qualify a country to join the common currency. So there was a feeling that nominal convergence was a very important part of the convergence picture to make a common currency function. Now, related to that, in the academic literature, the economic literature on convergence, I think the primary focus was on the issue of cyclical convergence. And that was, does the group of countries constitute an optimal currency area? And one of the criteria for an optimal currency area would be, are countries in the same phase of the economic cycle at the same time? If they are, then the monetary policy makers can make their decisions in a relatively straightforward way. We're booming, raise interest rates. We're in bust, let's lower interest rates. And that would be an easier decision if everyone is booming or is in boom or bust phase at the same time. So this cyclical convergence was of a lot of importance in the early conceptual discussions in the economics field about whether convergence was important. The real convergence was there at the beginning, and I'll refer to this a bit later, but there more in the terms of a political objective. That one of the promises that was being made by the political masters who were pushing this process forward was that we were going to get a convergence of income levels in Europe as a result. So it was considered to be more of an outcome than a prerequisite for successful monetary union. Now, under cyclical convergence, I've disaggregated that into two components because in our research, we've gone into a second component of cyclical synchronization, which is to look at financial cycles. So there's an emerging economics literature that looks at the evolution of financial indicators as a related but not totally interdependent component of business cycles as a whole. So whereas the business cycle is looking at economic growth over time, the financial cycles is looking at the evolution of credit, real estate prices, and indicators like that over time. And there's an emerging literature where we look at sort of how those financial cycles interact with business cycles. So in our research, we looked at both components, the business cycle component and the financial cycle component. And we get some interesting results there. The final component is structural convergence. The term structural convergence is bandied about in Brussels a fair amount. I'm not a big fan of it, because it seems to imply that we have to end up with the same structure. The structures have to converge. And I think from an economic standpoint, what's really crucial for Europe is not that the structures converge in every aspect, but that structures are sufficiently flexible to allow for asymmetric shocks. So the issue of structural convergence is a bit different, which is saying, well, let's all have the same legal framework for this or that aspect of the economy. There are reasons why that might be a good idea, but more important from an economic standpoint is, do we have sufficient flexibility under monetary union? Having given up the tool of monetary policy, given up the tool of exchange rate depreciation, do we have sufficient structural flexibility to adjust to economic shocks when they come? And so that's sort of the structural convergence component. Now let's take a step back and see why this is an important issue. If you look at economic performance in some of the major Eurozone countries over the last decade, you see an enormous divergence within Europe of the per capita GDP. So on the one extreme you have Germany, the black line, which is well above its pre-crisis GDP level. In fact, it crossed back over the threshold of pre-crisis GDP level way back in 2011 and has performed reasonably well since then. France, notwithstanding the pessimism about the French, about their own economy, has actually not performed particularly badly because it also crossed over the threshold around 2011, but hasn't performed quite as well. And on the other extreme, we have two different scenarios represented here by Italy and Spain. In the case of Spain, we have a very deep downturn, which doesn't actually bottom out until 2013, 2014. On the up-hand side, however, the recovery in Spain has been quite robust. And Spain is now moving back above its pre-crisis GDP level, and growth continues to look quite rosy, with perhaps a blip for Catalan independence uncertainties. But this is also an interesting picture. Now, on the other hand, we have Italy, which is, to simplify a little bit, is what an economist might call an L-shaped recovery, which is to say it goes down and then stays down, which in fact is no recovery at all. Now, it is true that now Italy is finally starting to grow. And growth in 2017 turned out to be much better than we had anticipated. I think our initial forecast a couple of years ago was 0.5% growth, and Italy has posted growth of around 1.5% in 2017. So it is starting to recover, but you can see it's a much different story when you compare Italy and Germany, certainly. Now, underlying these growth differences are productivity differences. And here we see total factor productivity for the same set of countries. And what you can see is that total factor productivity in Germany has grown over the last 18 years by about 10 percentage points. Now, by historical standards, that's actually quite weak. And there is an underlying story here about a decline in productivity worldwide, including in the US. And we can talk about that a little bit later if you're interested. But even within Europe, there is this divergence of productivity. So Germany doing relatively well. France about at the Euro area 12 average of about 4% productivity growth. That's not, when you sort of factor into the fact that this is 18 years we're talking about, 4% productivity growth in 18 years isn't anything to write home about. Spain, declining productivity initially, recovery of productivity more recently, which mirrors sort of the economic performance more generally. And then again, you have this sort of L-shaped performance on the Italian side, where Italy's factor productivity is 5 percentage points below where it was in the year 2000, which is a shocking decline in the efficiency of operations of the economy. It's clear that you're going to have income divergence when you have these underlying productivity divergences of that order of magnitude. There's another slide that we've produced which takes another cut at this data. And what we've done here is we've divided the countries of the initial countries in the Eurozone into two groups. And we call them high initial productivity countries and low initial productivity countries. So in the low initial productivity countries, we have essentially Italy, Greece, Spain, and Portugal. And then the others are in the sort of high productivity group. And what we see over the period of decades here is essentially everyone's growth is declining. That's the black diamond there. And then the composition of growth also changes in interesting ways. If you look at the high initial productivity countries, what you see is initially a very strong productivity component of growth. A somewhat weaker component of growth is coming from capital investment, and then a much smaller one coming from labor supply. So there's not a large contribution of increase in the workforce, but there is a modest contribution of capital and a significant contribution from factor productivity. If you look then in the first 7 years of this millennium, you see a decline in productivity, something of a decline in capital, and a continued decline in labor. And of course, this is reflecting demographic trends as much as anything else throughout the Eurozone. And then look at the crisis and post-crisis years. First, of course, growth has dropped. Total factor productivity still positive, but less positive than it was. This is part of this global decline in factor productivity growth. Capital, quite small contribution. This is reflecting the drop in investment during the crisis. In fact, Eurozone investment has not yet recovered to its pre-crisis level. It's still below what it was in 2007, 2008. And then, of course, an increasingly negative contribution from labor. So that sort of explains the slow growth performance of the high productivity countries. Now, when we look at the low productivity countries, we see a similar picture, but much more extreme. Initially, weaker total factor productivity, but much stronger contribution from capital investment, and somewhat stronger contribution of labor. In the boom years, labor is contributing more. This is in part due to increased labor force participation and immigration in some countries like Spain, for example. High capital investment, but low factor productivity growth. And then we see this dramatic change in the crisis and post-crisis years, where the contribution of capital is very slightly positive because investment has been weak. The contribution of labor has become much more negative, in part because of high unemployment, but also because of aging populations and labor force participation. And then the contribution of total factor productivity actually negative. So you can see this divergence phenomenon from the productivity side.
Can
Yes.
you just explain a little bit about a very basic question? TFP is what beyond labour productivity and capital productivity?
So essentially the way we economists do it is we fudge this a little bit. We run regressions where we put capital, we put labor, and then everything that's left over is total factor productivity. So it's essentially a residual when we've mapped the labor and we've mapped the capital. Now, what would this represent in reality? This would represent things like use of technology, managerial efficiencies, those types of things. So for example, if you could think about, I bought a machine in 1990 that can produce 500 widgets an hour, and I buy a machine now for the same price. So it's the same amount of capital investment, but the number of widgets that it produces is significantly higher. Then I've got that higher capital productivity that would be recorded there. The same with the labor. And then these other sort of intangibles that we're not able to measure very well is all caught up in the total factor productivity.
This is per capita, so unemployment doesn't make labour go down. Because
Well, it's per capita of the population, not per capita of the workers, right? So what we measured it here is according to the per capita of the population. So when someone loses their jobs, it's a lower labor contribution to the GDP per capita. Yeah, okay.
it says it isn't anything to do with the production function.
Well, this is how we estimate this, is with the Cobb-Douglas production function. Yeah, but yeah.
The labour inputs aren't, and it's got constant returns to scale,
Mm-hmm.
and there's capital input, and everything, and so there's labour inputs and capital inputs, and everything else is TFP.
Correct.
Okay.
Yeah. So there have been some adjustments in some of these low productivity countries in recent years. And what this chart shows very interestingly is this dramatic increase. These are relative unit labor costs. So how much it costs in labor terms to produce a unit of production. And you see this dramatic increase in the cost to produce a unit of labor, or the cost to produce a unit of output, from the labor cost to produce a unit of output in Spain, Greece, Italy, and to a lesser extent Portugal. In the meantime, unit labor costs in Germany are actually declining, in part due to wage moderation, but also due to this productivity growth that Germany is demonstrating. And you have the opposite phenomena in Greece, Spain, Italy, and Portugal. In fact, I have another chart that I didn't bring, but we have an interesting chart comparing wages and productivity in the manufacturing sector in Italy and Germany. And what you see is the wage increases in Italy and Germany are quite similar, but the productivity performance is widely divergent. So the cost structure here is coming mainly from productivity. In Spain, it's a bit more balanced. It's both higher wages, higher wage growth, and lower productivity than in Germany. But what you see is that in the crisis years, particularly in those countries, Greece, Spain, and Portugal, that had adjustment programs, there is a partial or complete reversal of this trend of higher unit labor costs. Unfortunately, a lot of this improvement in the trend is coming via the cost side, not via the productivity side. So we're getting labor costs down in Spain, but it's because there's been wage compression, not because we've ramped up the productivity growth in Spain, which would be the ideal solution. Again, here the interesting outlier a bit is Italy, where we haven't seen the same degree of moderation in unit labor costs. So there's a competitiveness gap that is opened against Germany that is still there. And of course, at the same time, Germany is not standing still. Unit labor costs are 10 percentage points below what they were 2 decades ago. So there is a problem there. Now, with this as sort of backdrop of the productivity divergences that we're seeing, let's look at what's happening with income convergence. And we've looked at income convergence using two indicators. The first one is what's called in the literature beta convergence. And beta convergence, very simply, is just you run a regression of the different countries against each other using the GDP at the beginning and the growth rate. And the higher GDP countries should have lower growth rates. The lower GDP countries should have higher growth rates. And that coefficient on that simple regression, the beta, should then be negative. So a negative indicator here, where you have GDP per capita on the one axis at the beginning of the period, and the growth rate during the period on the other axis, the sharper the negative slope, the more convergence we've actually seen. And what you can see here is if you look at the red line and the red dots, which represent the original members of the euro, you see very little convergence. In fact, that line is very slightly negatively sloped. If you were to take Ireland out of this regression, the downward slope disappears completely. There's been no convergence. Of course, Ireland has converged enormously, going from one of the poorer countries to one of the wealthier countries over that period. Another thing which is not even less nice to point out is that Italy is actually tilting the curve downward, because although it's a higher income country, it's been growing so slowly. And if you take Italy out of this analysis, it also doesn't slope downward. So Italy has been converging from the wrong side. They've been converging from above the mean to below, to closer to the mean, which is not what we want when we talk about convergence. We should be talking about converging up to the higher levels rather than converging to downward to a mean. So there's not a lot of convergence that you see in this particular presentation. However, the good news is when you throw the new member states of the euro into the equation, you do get very robust convergence. So these countries, Latvia, Estonia, Slovakia, Slovenia, are tilting that curve dramatically in favor of convergence. They're quite poor when they join the euro, and they're bringing that up as well. Now, I should point out that this is the same years for those countries. So we're including the time period before they joined the euro. It's before the euro for everybody, but there is a lot of convergence going on before they even join the euro, is what I'm trying to say. There's a question there.
Yeah, I mean, all those new countries, those economies are much smaller than France, Italy, Germany. Have you accounted in any way for that?
So these are not weighted according to GDP. So the answer is no. We haven't taken into account the size of the economies. Every economy is just a dot on this plot here, as it were. Yeah. It's an interesting thought whether or not that would be a good idea. Yeah. I mean, the problem is you have some economies that are so large that they pull the sample very, very sharply in one direction. But yeah, I'll think about that. Here's a second way of looking at the issue of convergence. And this is what's called in the literature sigma convergence, sigma being the coefficient of variation. So what this does is every individual year, it calculates the coefficient of variation among all the member states. So you just take the numbers of per capita GDP in purchasing parity terms, you do a coefficient of variation, and so you have a spread for every year, and you measure the size of that spread going up or down. So this gives you a bit of a time series look at what's happening here. And what we see here, a very interesting phenomenon. Very strong convergence in the 1960s and 1970s. There was a lot of catch-up going on in the poorer countries in that period. Then you have a period relatively flat, say 70s and 80s, and then you see another mild convergence episode in the run-up to the euro. So as countries are preparing to join the euro, it does appear that there's some convergence on that red line. And then in the period since the euro has been established, two interesting set periods. One initially essentially flat, no convergence but no divergence, and then a very sharp divergence in the wake of the crisis. And of course, having seen those charts on per capita GDP and productivity that I showed you before, you know exactly why this has happened. A sharp divergence in the economic crisis. When we add in the new member states, the other 7, we get an interesting pattern where we have fairly strong convergence in the early 2000s. Of course, that's the time when these countries are preparing to join the euro. They're not in yet, or they're joining in the process of this period. And then a period of roughly unchanged convergence and a slight uptick in the crisis. So an interesting pattern between the two, where we have this downturn in variation, then a flat period, then an upturn. Now, certainly part of this divergence that we're observing here is cyclical in nature. And as the economies of Europe recover, we may see some reversal of this uptick. But look at the size of the uptick. The degree of dispersion of GDPs of these original 12 members is essentially back to where it was in the 1960s. It's a dramatic increase in that dispersion of incomes. It's not a trivial amount. So it's going to take a lot of years of Italy growing slightly faster than Germany if they're going to close the gap that has opened up in the last 15 or 20 years. In fact, probably that's unlikely to happen, right? But that's the challenge that's out there. Here's a zoom in on the new member countries so you can kind of see what's happening. And basically, with the exception of Cyprus, which was already a relatively high-income country, there has been a really very, very pronounced convergence pattern in these different new member states. These are also with the years of when they joined the euro. So that's the story on income convergence. Let's move now to the story on nominal convergence. And I'll be briefer here because I think this is a story that is better known. But I just want to highlight an interesting phenomenon here. There was a high degree of convergence in both interest rates and inflation rates before the euro happened. No surprise there. That had to happen or you couldn't join. That was one of the rules of getting in. So no surprise that here on the real long-term bond yield, you see this dramatic decline in real interest rates, the differential with Germany. This is the spread vis-a-vis Germany. So Germany is 0 here. You see this great decline in the spreads vis-a-vis Germany before the joining of the euro. Now here's where it gets interesting. Both inflation and interest rates converged. But interest rates converged even more quickly than inflation. And so inflation was declining by less than interest rates. And the result was when you look at real interest rates, that is taking nominal interest rates and deflating them by inflation, you actually see real interest rates that are lower than Germany for a significant period of time. The nominal rates are still higher, but the real rates are lower. And you can see why there was a huge credit boom in places like Spain. The real interest rate was actually lower than it was in Germany, and that was fueling this economic boom, financial boom, and we'll talk about the financial cycle in just a minute. So that's an interesting phenomenon. We really had overshooting of the real interest rate convergence because I don't think anybody anticipated that real interest rates would be lower in Spain or Portugal than they were in Germany. But that's in fact what happened for a period of years. Now, when the crisis hit, of course, that all went backwards, right? Because markets woke up and realized that all member states of the euro were not risk-free assets to hold. And they started assigning risk premia, in some cases very dramatic risk premia, like you see here in Portugal, to those assets. And that has now calmed back down, and those spreads have come down very significantly. So the nominal convergence story is huge convergence in the run-up to the euro, overperformance in some sense in that middle period, then some divergence with the crisis, which is now resolving itself. When we turn to the business cycle analysis, we looked at two different concepts here. One is what we call in the literature here concordance of the business cycle. And that simply is, are you in the same phase of the business cycle at the same time? So concordance is a measuring essentially the different phases of an economic cycle, the bust, the sustained growth, the overheating, those different cycles, and then saying, are countries in the same phase of that cycle at the same time? And what you see here on the left-hand side represents that degree of concordance. And here the news, I think, is actually rather good. We're starting with concordance of about 0.6, where 1 would be perfect. So maybe 60% of the time we're in the same phase of the cycle. And over the last 30 or 40 years, we've gone from under 0.6 to 0.75 concordance. That's good news for Mario Draghi because it means when he's trying to make a decision of whether to raise or lower interest rates based on where we are in the economic cycle, he's got a lot of countries in the same phase of the cycle at the same period of time. So that's good convergence news for the European Central Bank. On the other hand, it's the old story about the two-handed economist, right? On the one hand, on the other hand. Well, on the other hand, we looked at another aspect of convergence on the cycles, which is to say, we know we're in the same phase of the growth cycle at the same time, but how about the size of that growth cycle, the amplitude of that sine wave? And what we find out here is that the amplitudes actually diverged. Initially, there was convergence, and then there was divergence in the amplitude of the cycle. And I'll show you in a minute, in a couple of slides, a really clear description of how that works in the case of a comparison of Spain and Germany. But yeah.
But if you had countries like the new ones, Latvia and all these new countries in the euro that start with low growth, low level of GDP, they will have higher growth rates if you have convergence. That's what you're looking for, right?
Well, yeah, but the business cycle is looking for deviations from the trend, right? So we're looking for growth deviations from the trend, right?
Also in the second panel. So that's the second panel is deviations from trend growth.
Yeah. So what we see is we see some convergence and then we see divergence.
And the trend is an HP.
Sorry.
The trend is an HP trend, is it?
Yeah, I think that's what we used. No, we used a Kalman filter, I think, if I remember right.
It's quite important.
I'll look it up. I didn't do these analyses myself, this part of it. So, yeah. Fortunately, I have some people who are quantitatively more literate than I am, and they were able to do that part of the analysis. Not that I'm quantitatively illiterate, but they're even more so than I am. Let's turn to the financial cycle issue. So remember I said we have business cycles and then we have financial cycles. They're related, but they're not the same thing. So I think this is one of the first pieces of research to look at this issue of financial cycles in the Eurozone. And we have a very interesting result that comes out of our research here. And that is that if you look at the blue bars here, that is the cumulative concordance of all the countries with every other country. And what you see is there's a slight decline in concordance in the initial phases of the euro, but there's actually a sharp increase in concordance in the later stage. So what does this mean? This means that countries are in different parts of their financial cycle, as opposed to the business cycle, less of the time now than when they started. That's good news. Every single country in the Eurozone is more concordant than it was at the beginning, with one exception. And that one exception is Germany. And that's interesting that it is Germany. If it were Latvia, we'd probably say, who cares, right? It's a couple million people in the Baltics, right? Of course, these are the first 12. I'm just using that as an illustration. But the fact that it's Germany is very important. What we're saying is that the financial cycle in Germany has become disengaged from the financial cycles of the majority of other countries. The correlation has gone down with Germany and every other country, while it's gone up with the others. So that's an interesting finding here. And let me just illustrate that point with this slide, which shows you just the bilaterals between Spain and Germany. So this is the financial sector indicator that we use. This is not one we developed ourselves. We use it from the literature. But it's essentially a composite which includes credit growth and real estate prices and then we compile that into an index, and we look how the index changes over time. And what you can see here is that there is both a desynchronization and a difference of amplitude. This red line, which is the German line, very mild fluctuations in the financial cycle. So you're not seeing these boom-bust cycles in real estate prices and in credit growth the way you're seeing in a country like Spain. And what you can also notice here is it does appear that those two sine waves are increasingly disconnected. In particular, 2006, where Spain is at the peak of a boom and Germany is at the depth of the trough. And we could see a similar picture. This is perhaps the most dramatic, but we could see a similar picture if we plotted Germany against other countries in the Eurozone. Now that does pose some interesting problems for Mr. Draghi. It poses even more interesting problems for the SSM. Because this is a financial cycle issue, and maybe the regulatory solution to this is not via macroeconomic policy, but perhaps, and we'll talk about this later, about macroprudential policy. So to summarize our findings about the different types of convergence, real convergence, that is to say per capita GDP convergence, we saw it happening before the euro, we saw it stall in the first decade of the euro, and then we saw this dramatic divergence in the crisis. On nominal convergence, we had strong convergence before the euro in order to join. Some stagnation on the inflation side while interest rates converged even more. And then we have a temporary divergence in interest rates due to country risk in the crisis, which is then reversing itself. On the business cycle side, the essential story here is we're getting more concordant. We're in the same phase of the cycle more of the time, but the amplitudes of the cycle are getting more divergent. They're going farther apart. Some are shallower, some are deeper, and the difference between the shallow and the deeper is getting wider. And we see a similar phenomenon on the financial cycles, where we get convergence on the synchronization of being in the same part of the cycle, but we get divergence in the amplitude between some countries and other countries. With that also caveat about Germany being out of sync financially. Now, moving from here to sort of more of a policy diagnostic and some policy recommendations, let's talk a little bit about what the originators of the euro thought was going to happen to foster convergence, particularly on the real side. And if we can go through these different items, there was this idea that these channels would generate convergence. The first one would be the old argument, I'm sure some of you remember this before the euro, saying, look, transactions costs are going to go way down, so trade is going to go way up. And that's going to generate better economic growth. It's also, in poor countries, it's also going to generate more synchronicity in the business cycle. What we see in the actual data is that there was a boom in trade among the 12 countries of the Eurozone, but actually trade outside of the 12 grew even faster. So differentially, that's not true. Trade grew, but not as fast as trade with the rest of the world grew. So that doesn't really deliver the convergence punch maybe that we were hoping. Another argument, of course, was labor mobility. If workers move from poorer countries to richer countries, they get higher incomes. Sometimes they remit some of that money back to their home country, which would raise the home country's income. And even if they don't remit money back, they're reducing the labor supply in the home country, they're increasing the labor supply in the host country, so wages should go down in the one and up in the other, and you'll get some convergence on the wage side, and that will help. What has actually happened in reality? And I had an interesting discussion with some of the previous people I presented this paper with. If you look at the share of foreign people working in a country that they were not born in the Eurozone, it's very low. It's still in this sort of small, lower single-digit percentages. If you look at the same figures for the United States, you would see something like 20-30%. So 30-35% of Americans are working in a state they were not born in. And only 4 or 5% of Europeans are working in a state or a country they were not born in. Now, of course, there are reasons why that's the case. The mobility is much greater. You don't have the language barriers. You don't have the culture barriers that you might have here. But that does not suggest, if you've got just a few percentage points of people working in other countries, that you're going to really get a stabilization function or a convergence function coming out of that. Now, there is some evidence, which we didn't look at in this paper, but was pointed out to me by one of the commentators earlier today and also on Friday when I presented this in Cologne, that on the margin, there does seem to be much more movement in Europe and less movement in the US. So this may be reversing to some extent, that mobility interstate in the US is falling, and mobility intercountry in Europe is rising. And so maybe the flows are looking more similar, even though the stocks are very different, which is a fair point. But the truth is, if you look at this over the last 20 or 30 years, labor mobility did not deliver convergence in the way that might have been envisaged. The third area was looking at capital flows. And to sort of sketch very broadly the concept here, I think the idea of many was richer European countries are going to invest in poorer European countries to take advantage of the cheaper labor costs. They're going to put factories there, they're going to produce goods there, and that investment flow is going to generate higher incomes, higher growth, and bring convergence to pass. If you look at the data, it's a very interesting phenomenon. German investment actually did go in two directions. It went to the south, but it also went to the east. And I don't think people had thought about the eastern side when they were thinking about the euro formation. But it's more than that. FDI, foreign direct investment, went mostly east. The money went south was essentially financial flows, portfolio investment, so-called hot money, that fueled real estate booms and consumer credit booms in the southern countries. So Spain has this huge real estate boom, this huge consumer spending boom, fueled indirectly by German money, partially. while direct investment of building factories and productive capacity was going mainly to Czech Republic, Slovakia, Hungary, Poland. So the money was going both ways, but it wasn't kind of the way we had anticipated. It wasn't generating productivity growth in those southern countries.
You include Italy in some.
Well, we were looking, in this particular part of the paper, we look more at German flows to Spain and Portugal and Greece, and just that kind of a flow. Italy is a separate case there because it has a very highly developed capital structure already. It's a high-income country. We weren't expecting that a lot of money would be flowing necessarily from Germany to Italy. So that's a good caveat. Thank you for pointing that out. So capital flows didn't really do what we had anticipated either because of the nature of the flows that we saw and the lack of productive direct investment generating additional economic capacity. Finally, on the structural adjustment side, there is a clear statement in the Delors report that proposes monetary union, where they say essentially, countries will realize, I'm paraphrasing here, but countries will realize that without the exchange rate mechanism, they will need to make their productive capabilities much more flexible, and they would undertake structural adjustments to make this happen. And of course, that didn't happen to a very large degree. And in the paper, we present some data. I didn't want to clog up this presentation with it. We present some data essentially looking at the OECD index of structural reforms and show that all countries in the Eurozone had some improvement in their structural indicators, but the gap was not reduced. So there was still a gap between the poorer and the richer countries, and that gap was not reduced because we didn't get differential structural reforms in the countries that we wanted to converge. Finally, there was an argument that we would have countercyclical fiscal policy. So we're going to set up a series of fiscal rules that, although we're leaving fiscal policy to the member states, the rules will help guarantee that they save in good times and they spend in bad times. That will help cushion it will help create cyclical convergence. It'll cushion that amplitude difference. But also, the research shows that cyclical downturns also have permanent effects on economic growth for at least a considerable period of time. So it would also help income convergence, because when your cycle is less severe, you get a recovery more quick, and your trend growth rate doesn't drop by as much. And here again, that didn't happen. Now we can argue about whether it was the rules that were poorly formulated or the countries who never obeyed the rules. I think there's plenty of blame to go around on both sides of that, but that didn't happen. And in fact, if you do an empirical analysis of fiscal policy in the Eurozone over the last decade or so, you find it's robustly pro-cyclical rather than counter-cyclical. So it was actually adding to the problem rather than fixing the problem. So in some sense, none of these original channels delivered as advertised, and that's part of the reason we've had the difficulties that we've had. Now, to be fair to our colleagues in the Euro area, they've realized this, and they took, in the period of the crisis, undertook some very significant actions to try to address some of the weaknesses in the European architecture that contributed to these problems that we highlighted. I think the most significant one of these would be the banking union, which is trying to address this so-called sovereign bank nexus, where banking problems become sovereign crises and sovereign crises become banking crises, and they exacerbate each other. And there has been considerable progress towards the banking union, but there's more that needs to be done. In particular, without a common European deposit insurance scheme and a fiscal backstop for the resolution fund, those costs will flow back into the individual member states, and we still won't have the kind of protection that the banking union was designed to help provide. There are some procedures that have been set up at a European level, the macroeconomic imbalances, the 2-pack, the 6-pack, the European semester, all designed to try to exercise some moral suasion on countries on issues like structural reforms and macroeconomic policy stance. With some limited success, I would say, in this area. In some cases, there's been some success, in others not. Finally, I think that this one with banking union are the two most important. The European Stability Mechanism has provided a fiscal backstop for countries in deep trouble. So there is an ultimate backstop for countries in absolutely severe downturns. And we can talk about the pros and cons of the way it's handled some of the country cases, and in particular Greece. The ESM has pumped, together with the EFSF, which was its predecessor, has pumped something on the order of 250 billion euros into those crisis countries, and that exercises obviously some significant stabilization effect there. So what could be done from here on to further the convergence process, real convergence and business cycle convergence? Well, on the business cycle side, we would see three main areas where there could be a contribution. One would be some kind of fiscal mechanisms, and by this I would mean let's revamp the fiscal rules and make sure that the fiscal rules actually can deliver counter-cyclical fiscal policy rather than pro-cyclical fiscal policy. And we have some specific ideas on that in the IMF. The second idea would be common backstops, a common fiscal capacity for the Eurozone as a whole. This is a tremendously controversial but much discussed issue right now. The European Commission has recently come out with a proposal. We're going to put out a paper next, I think, early March with our own proposal in this area on how a relatively small fiscal backstop, if you accumulate resources over time and have a borrowing capacity, could allow for a significant stabilization function. So that would be another area. And then finally, of course, if you have a more flexible economy, you will be able to absorb shocks better, and absorbing shocks better means that the amplitude differences on the business cycle would become less. So those three areas. On the financial cycle side, here, I mentioned this earlier, macroprudential policies are key. If you're going to deal with real estate bubbles and credit bubbles, especially in consumer credit for the so-called less productive sort of credit flows, macroprudential policy has to be the way. I would have the same recommendation to the United States, which has a single central bank for its country, but it's even more true if you have a common currency area across multiple countries because of the fact that the credit conditions may be quite different in different countries. To be fair to our colleagues in Spain, Spain tried to use macroprudential policies to rein in the credit boom that they had in the pre-crisis period. They knew the problems they were having. And I have to say, to give the Spaniards some credit, they were running a fiscal surplus and had macroprudential policies before the crisis. They knew what they were facing and they were trying to lean against the wind there. In the retrospect, the storm was just much bigger than any of us had anticipated. But a more aggressive use of macroprudential would be important in the future. Completing the banking union to provide that Euro-wide backstop that doesn't involve individual countries footing the whole bill of the problems that come across certain banks would also be important. And then capital markets union can also play an important role. There's some interesting research on the United States which suggests that much of the interstate stabilization happens not through fiscal policy, but through capital markets. What happens? A company goes bankrupt in Alabama. But most of the owners of that company are stockholders all over the United States. So the losses are not located in Alabama per se, they're shared across the entire union in the US. Likewise with bondholders. If the bonds default in Alabama, many of those bondholders are in New York, they're in Los Angeles, they're in Chicago, and that spreads out the shock across the union as a whole. So capital markets union would be a way to increase that type of an operation in Europe as well. And of course, to just kind of close the cycle here back to banking, one of the reasons why this functions more effectively in the US than in Europe is also because Europe is much more dependent on bank financing. And the US is much more using capital markets, equity and bond markets. And those defaults will automatically share across. Equity will automatically be wiped out in a default. But bank lending becomes a much different issue. If the bank is in the same country as the company that goes bankrupt, all of those losses stay within the national sphere and they exacerbate the downturn in that particular country rather than spreading it out across the union. So that's an important aspect of it as well. Finally, on the real convergence side, bringing us back to where we started this discussion, boosting productivity growth is ultimately what is going to be required, particularly in the countries where productivity growth has lagged behind the Eurozone average. In this area, growth-enhancing structural reforms can play a role, and growth-friendly fiscal policy can also play a role. And by growth-friendly fiscal policy, I do not mean deficit spending. I mean looking at the composition of your spending within whatever budget envelope you have and trying to orient it more towards things that will generate productivity in the future. That's things like infrastructure, research and development, education, technical training, rather than some other possible priorities for economic growth. We did a little exercise in our Euro area team with one of our economic models and said, what would happen if we did a comprehensive set of structural reforms across all Euro area countries? And so we did a little simulation on what would be the growth impact on labor productivity from doing a comprehensive set of economic reforms. And what you see is there's a positive impact, surprise, surprise. But also that the positive impact is much higher for the same set of reforms in the low productivity countries. They've got more to gain because they're starting from a lower base. Now, I wouldn't take these numbers seriously. This is just a simulation from a hypothetical set of reforms. But I think the illustration qualitatively is useful to say, wait, there are significant gains that could be gained in terms of productivity by comprehensive structural reforms.
So what's in your set of reforms then?
Pardon?
What's in your set of reforms then?
I would have to look back at the report. It's a separate report from our research, but it was a package that included both product and labor market reforms. Things like liberalization of protected service professions and liberalization of retail marketing, market rules, commercial rules, and as well as labor market rigidities.
Also the McCrone reforms.
The McCrone reforms, well, his reforms certainly would be the type of reform that we're looking at. And in fact, our French team is now doing a quantitative analysis of what we think the Macron reforms would look like. I expect in the next few months that will be published as well. Yeah. And we're quite bullish on his reforms. I mean, we can argue about whether they go far enough, but I don't think we can argue about that they're going in the right direction. But that would be our view as the IMF. So one final point. In purely economic logic, there is not necessarily a reason why you can't tolerate income divergence eternally in a monetary union. Think about Panama or Ecuador, who unilaterally adopted the US dollar. In the case of Ecuador 20 years ago, in the case of Panama 50 years ago. There's no expectation that those countries' income levels are going to converge to the US, and it doesn't seem to impede their use of the dollar, the fact that they're not converging. But of course, the European Union is a very different animal. This is also not the unilateral Euroization of Montenegro. There was a clear political expectation that the monetary union would bring with it certain tangible economic benefits, particularly for those in poor countries, and particularly to bring the welfare levels closer together. So independent of the economic analysis here, I think there's a clear political reason why income convergence becomes a very important issue for Europe today, particularly given the challenges that it is facing. Let me stop there. Thank you very much for your attention, and I'm happy to take any questions or comments you might have.